Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at Micron.
If you find our talks useful, please consider subscribe, like, and comment underneath. We actually get a lot of requests that say, please generate an audio summary for Smart Wealth with Joshua for Micron. So we are jumping right into that deep dive today.
Yeah, it's a fascinating one to unpack right now.
It really is. Because, there is a fundamental rule in the stock market that you and I, and pretty much every investor, we just accept it as financial gravity.
Right. What goes up has to get expensive.
Exactly. When a stock goes on an absolute tear, like rallying over 540% in a single year, blasting through historical ceilings to hit fresh 52-week highs,
Yeah.
that stock is supposed to become incredibly expensive.
Oh, yeah. The valuation is supposed to get completely stretched out.
Right. If you are buying in at that point, you fully expect to be paying 30, 40, maybe 50 times forward earnings because you are paying a massive premium for all that momentum.
Yeah, the market usually prices that kind of hypergrowth to absolute perfection. You expect it to be priced like a luxury asset where any slight miss in earnings just sends the whole thing tumbling down.
But here is the massive disconnect we are exploring in today's analysis. We're looking at a company that just did all of that,
Yeah.
and yet it is currently trading at a jaw-droppingly cheap valuation of just 7 to 8 times forward earnings.
Which is honestly wild to see.
It's priced like a stagnant, boring utility company, but it's growing like a Silicon Valley startup on rocket fuel. So our mission today, digging through all these analyst notes, the earnings transcripts, the technical charts, is to figure out how on earth does this happen?
Yeah, have we found a permanent structural shift in the tech sector? Or, is the market actually right to treat this like a value trap?
Right, so what is the broad takeaway here?
The short answer is that the broader market is just suffering from muscle memory. Historically, memory chip makers have been these intensely cyclical businesses. They boom, they overproduce, prices completely crash, and then they bust.
And investors who have been burned by that cycle are obviously hesitant.
Exactly. But when we actually analyze the underlying mechanics of what this company is selling right now, and importantly, the physical constraints of how they manufacture it, the data points entirely away from a cyclical peak.
So we are looking at a paradigm shift.
We are. It's a paradigm shift driven entirely by the artificial intelligence supercycle.
I really want to dig into those mechanics because the first quarter numbers for fiscal 2026 are, honestly, they're hard to wrap my head around.
They are massive.
If you were holding this stock, you are looking at revenue that nearly tripled year over year. Tripled. They pulled in $23.86 billion for the quarter.
Oh, wow.
Yeah. And earnings per share came in at $12.20. But the guidance is where it gets truly wild.
What are they projecting?
They're projecting third quarter revenue to push $33.5 billion with gross margins of 81%. Now, my understanding is that 81% gross margins in hardware manufacturing is just, it's almost unheard of. It sounds like a software margin.
It does, yeah. Achieving an 81% margin on a physical manufactured good means you have achieved almost total pricing power over your customers.
Total pricing power.
Right. And to understand the mechanism behind that power, we have to look at the physical architecture of their new product line.
Okay, let me try a metaphor here to see if I am grasping this. For decades, manufacturing standard memory was essentially like building public highways. Any major tech company could build them.
Right. It was just a commodity.
And eventually, you get too many highways, they get congested, the tolls drop to pennies, and nobody makes any money. It's a total race to the bottom. But looking at these 81% margins, it feels like they stopped building public highways and suddenly realized they own the only real estate capable of supporting an exclusive high-speed rail line for AI.
That is a perfect analogy.
How did they suddenly acquire this massive moat?
Well, the technological equivalent of that high-speed rail line is high-bandwidth memory, or HBM.
Yeah.
Standard memory chips, your public highways, are what go into standard laptops and regular enterprise servers.
Right, everyday stuff.
Yeah, but you cannot train a sophisticated artificial intelligence model on a public highway. Large language models need to pull just staggering, unprecedented amounts of data simultaneously to function.
So they need a different architecture.
Exactly. High bandwidth memory physically stacks the memory chips vertically, sitting right next to the processor, which creates a massive multi-lane superhighway for data.
I see.
And because the engineering required to stack these chips without them, completely overheating is so incredibly complex, HBM commands prices 3 to 4 times higher than standard memory.
I was looking through the analyst notes, and they keep using this ominous phrase when talking about HBM manufacturing. They call it The die penalty?
Yes, the die penalty.
It sounds like a manufacturing error or a massive flaw. Why is this so-called penalty actually driving the stock price up?
The die penalty is basically the hidden physics engine driving this entire 540% rally. The word die refers to the physical silicon real estate on a manufacturing wafer. Producing high bandwidth memory requires highly complex advanced packaging. To make a single stack of HBM, so to build your high-speed rail line, it eats up roughly 3 times the standard silicon wafer capacity on the factory floor compared to regular memory.
Oh, wow. So if I am the manufacturer and I am dedicating my factory space to building this highly profitable AI memory, I basically have to bulldoze my existing public highways.
Right. You have to.
I am actively cannibalizing my ability to make standard, everyday memory chips.
That is the exact mechanism. You are physically starving the broader market of standard supply. And, well, basic economics tells you what happens when supply plummets.
Prices go up.
Exactly. Because of the die penalty associated with HBM production, the global supply of commodity memory tightened so violently that standard memory prices shot up 90 to 95% in the first quarter alone.
That is insane. So the company is making a fortune on the premium AI memory, and because making that premium memory restricts their factory space, they're also making an absolute killing on their legacy products.
It is a complete self-reinforcing loop created by physical limitations.
And reading further into the data, this isn't just a temporary squeeze. They recently secured their first ever 5-year strategic customer agreement.
Which is a massive departure from the industry norm. I mean, historically, memory makers couldn't predict their cash flow 2 years out, let alone 5.
Because of the boom and bust cycle.
Right. But by securing that agreement, they have locked in demand at specific volumes for half a decade. That effectively severs the cord on that old boom-bust cycle we talked about.
It just completely changes the game.
Yeah, it gives them unprecedented revenue visibility, which fundamentally alters the risk profile of the entire business.
Because they have locked in this unprecedented 5-year revenue stream, their risk profile has entirely changed. We can actually see that structural shift reflected in how they are managing their balance sheet right now.
Oh, absolutely.
Instead of just listing off a spreadsheet, let's look at the sheer scale of the financial fortress they are building here. They're sitting on $16.7 billion in cash.
Which is a huge buffer.
Yeah, and they generated a record $6.9 billion in quarterly free cash flow. Their debt-to-equity ratio is currently sitting at just 0.13.
That is incredibly low.
Right. For a capital-intensive manufacturing business that requires multi-billion-dollar fabrication plants, operating with a 0.13 debt-to-equity ratio means they're practically running without leverage.
And their return capital, too.
Yes, they just hiked their dividend by 25% to an annualized $0.60, representing a tiny 2.83% payout ratio.
The strategic advantage of that balance sheet in today's macroeconomic environment, well, it really cannot be overstated.
Because debt is so expensive right now.
Exactly. With interest rates where they are, many capital-intensive companies are just being crushed by the cost of debt when they try to expand. But this company is incredibly well capitalized to fund its future growth internally.
But let me play devil's advocate here for a second, because if you are a retail investor looking at your portfolio right now, there is a glaring red flag that can make you hit the panic button.
Okay, let's hear it.
If the numbers are so flawless, and the balance sheet is a fortress, and the 5-year outlook is guaranteed, why are the insiders selling the high-speed rail?
The insider selling.
Yeah. Executive Vice President Sumit Sadana and Executive Vice President April S. Arnzen combined to sell over $24 million worth of their stock in April. Is management secretly seeing a cliff that we aren't?
It is a totally natural reaction to see insider selling and just assume the worst, right? But you have to look at the legal and regulatory mechanism of those specific sales. The filings show these were executed under Rule 10b5-1 trading plans.
I see that term thrown around a lot. What does that actually mean in practice?
So a Rule 10b5-1 plan is a prearranged automated selling schedule. The SEC created this rule so that corporate insiders could sell their stock without facing accusations of insider trading.
Oh, so they set it up in advance.
Yeah, executives set these plans up months, sometimes even years in advance. They mandate that a specific number of shares will be sold on a specific calendar date, or, when the stock hits a specific price threshold, completely regardless of the current internal company data.
So the executives aren't waking up, seeing a bad internal memo, and calling their broker to dump shares, It's essentially a blind automated algorithm pulling the trigger.
That is correct. They are simply diversifying their personal portfolios on an automated schedule. It carries zero informational value about the company's future prospects.
Okay, so if the executives aren't panicking, who is actually on the other side of those trades?
Mhm.
Who is buying up all these shares at record highs?
That is where the story gets really compelling. The institutional accumulation, the smart money, is just staggering right now. And it's coming from vastly different types of institutions.
Like who?
Well, Norges Bank, which manages Norway's sovereign wealth fund, just initiated a massive, brand new $6.4 billion stake. Yeah, and AQR Capital, which is one of the most sophisticated quantitative hedge funds in the world, increased their position by almost 412%. And David Tepper's Appaloosa Fund, known for making incredibly sharp macroeconomic bets, upped its stake by 250%.
That is a fascinating cross-section of buyers. You have sovereign wealth looking for long-term stability, quants like AQR seeing a mathematical mispricing, and macro funds riding the structural tech wave.
It really covers all the bases.
You don't see those three distinctly different groups allocate billions of dollars unless there is a very deep multi-year thesis unfolding. And we can actually see that institutional footprint leaving tracks in the technical price action.
Oh, absolutely. The technicals are reflecting sheer, undeniable volume.
Let's break that down for the listener. On April 22nd, the stock hit a fresh 52-week high of $491.98. It shattered the heavy resistance level at $471.50, and it did it on massive volume.
How massive?
We are talking 45.4 million shares traded against an average of 40.5 million. It is now sitting 13.6% above its 20-day moving average and a massive 26.5% above its 100-day.
That is a serious breakout.
It is. But I am looking at the analyst notes, and they highlight two specific indicators, a MESCD of 8.88 and an RSI of 60.50. Honestly, for those of us not staring at Bloomberg terminals all day, what do those specific numbers actually tell us about the health of this rally?
Let's strip away the jargon. MACD stands for Moving Average Convergence Divergence. It is a mathematical calculation that subtracts a longer-term moving average of the stock's price from a shorter-term moving average.
Okay, so it measures momentum.
Right. When the short-term momentum is aggressively outpacing the historical baseline, the number goes positive. And 8.88 is a very decisive positive buy signal. It basically proves the upward trend is accelerating, not exhausting itself.
And the RSI, the Relative Strength Index.
So RSI measures the speed and magnitude of recent price changes on a scale from 0 to 100 to evaluate whether a stock is overvalued or undervalued. Typically, anything over 70 is considered overbought.
That is usually when you see retail traders chasing a meme stock out of pure FOMO, right? The price runs up too fast and is due for a violent pullback.
Exactly. But an RSI of 60.50 is the Goldilocks zone. It indicates strong, healthy, sustained buying pressure. It implies that those massive institutional players, the AQRs and the Norges banks, they are deliberately and methodically accumulating shares, rather than it just being an unsustainable retail frenzy.
That deliberate institutional accumulation completely explains why Wall Street analysts are essentially in a bidding war right now to update their forward models. We are seeing major upgrades across the board.
Yeah, the price targets are flying up.
You have legacy banks scrambling to catch up, Mizuho raising to $530, UBS going to $535, JP Morgan to $550. But then you look at Cantor Fitzgerald, and they are planting a massive flag at a $700 price target.
Which is a huge jump.
And this circles all the way back to the valuation anomaly we started the show with.
Right, the 7 to 8 times forward earnings multiple. If we look at the consensus estimates, analysts are pointing to an earnings per share of $99 by fiscal 2027.
Okay, so let's do the math on that.
Yeah, if a company generates $99 in earnings per share and the stock achieves Cantor Fitzgerald's target of $700, you divide the price by the earnings and you get a PE multiple of roughly 7.
For a company at the absolute bleeding edge of the artificial intelligence revolution, a PE of 7 is a glaring, almost absurd mispricing.
The market is fundamentally mispricing the structural demand curve. They are basically discounting the stock because the trauma of the old boom-bust cycles is still baked into the algorithmic trading models.
Well, let's step into the shoes of the market algorithms and explore that trauma. Let's build the bear case because, friction is where we find the truth.
Let's do it.
The primary risk everyone points to with memory manufacturers is capital expenditure. This company is planning a massive $200 billion CapEx build-out. Their biggest competitor, Samsung, is spending $73 billion.
That is a lot of new factories.
It is. And historically, when memory companies spend hundreds of billions building massive new fabrication plants, it inevitably leads to a huge oversupply glut. The market floods, prices collapse, and the cycle starts over. Aren't they just building towards a massive cliff post-2026?
It is the most logical historical fear, and it is exactly why the stock is cheap today. But the physical reality of the AI supercycle fundamentally alters the timeline of that fear.
How so?
First, their entire high-bandwidth memory output is already completely sold out for calendar 2026.
Wow, already?
Yes. And looking at the broader industry data, demand for AI memory is projected to drastically outstrip supply all the way through 2028. Yes, they are building massive new capacity, but these fabrication plants take years to come online.
You can't just flip a switch.
Exactly. You have to build the clean rooms, install extreme ultraviolet lithography machines, and perfect the yields. The demand curve is so incredibly steep that the oversupply risk is pushed far beyond the current 18 to 24-month investment horizon. They simply cannot physically build factories fast enough to meet the demand.
Okay, I will concede the physical supply constraint. Building factories takes a long time. But what about the software side?
What do you mean?
I'm looking at reports regarding Google's new TurboQuant memory compression algorithm. The entire goal of that software is to make AI models highly efficient so they take up less memory footprint.
Right.
So if the algorithms get smarter and more compressed, won't the world suddenly need significantly less physical memory hardware? Doesn't software efficiency destroy the hardware thesis?
That is a brilliant question, and to answer it, we have to look at an economic principle known as the Jevons paradox.
The Jevons paradox.
Yes. Back in the 19th century, an economist named William Stanley Jevons was observing the coal industry. Engineers had just invented a new, highly efficient steam engine.
Okay, tracking with you.
Everyone assumed that because the new engines used much less coal to produce the same amount of power, the total consumption of coal across the country would drop. But Jevons observed the exact opposite.
Let me guess. Because steam power became cheaper and more practical, everyone started using it for absolutely everything.
Precisely. The efficiency didn't destroy demand, it democratized it. Total coal consumption skyrocketed because steam engines were suddenly put into factories, trains, and ships everywhere.
So how does 19th century coal apply to Google's TurboQuant algorithm and artificial intelligence?
Well, if TurboQuant successfully compresses AI models, the cost of running AI compute drops significantly. When the cost of AI compute drops, you don't use less of it. You start putting AI into absolutely everything.
Oh, I see.
It transitions from massive server farms into every smartphone, every home appliance, every electric vehicle, and every localized edge device. By making the models more efficient, software engineers are actually going to stimulate a massive exponential increase in the total volume of memory needed globally.
That is fascinating.
Yeah, the software efficiency acts as a catalyst for massive hardware adoption, completely neutralizing the threat of reduced demand.
That entirely flips the bear thesis into a massive bullish tailwind. Efficiency isn't the enemy of demand, it's the accelerator. So if the structural demand is locked in and the balance sheet is pristine, what should you be watching for? What does the immediate catalyst calendar look like over the next 3 months?
The most explosive upcoming catalyst will undoubtedly be the Q3 earnings report, which is expected to drop in late June or early July.
Okay, so coming up soon.
Yes. We already know they guided for $33.5 billion in revenue, but given those 81% gross margins and the severe supply constraints in the broader market pushing up standard memory pricing, there is a very strong mathematical probability they will have to revise that revenue guide upward.
And an upward revision in this macro environment would be a violent short-term catalyst, especially since we are seeing some broader macroeconomic tailwinds aligning right now.
Like what?
Well, we are seeing a general de-escalation in the Middle East, specifically the Iran ceasefire extension, which has brought some risk-on stability back to the markets. Plus, there is talk of potential tariff reductions on China, which historically benefits high-beta semiconductor stocks heavily.
Definitely. And obviously, we're just looking at the market mechanics here, not taking sides on any of the politics.
Of course. But beyond the standard earnings calendar, there are two major, unconfirmed rumors floating around the research stack that could radically alter the landscape.
The first rumor revolves around geopolitical strategy. There are multiple reports indicating that they are aggressively lobbying Congress to implement strict export controls on advanced ship-making tools, specifically targeting their overseas rivals.
Now again, purely from an economic perspective, how would those export controls impact the stock?
From a market mechanics perspective, it is a brilliant defensive maneuver. If those export controls are enacted, it artificially caps the ability of competitors to scale their advanced memory production.
Because they can't get the equipment.
Exactly. They won't be able to buy the specialized tools required to build their own high bandwidth memory. It effectively legislates a protective moat around domestic market share, ensuring that the die penalty pricing power we discussed remains exceptionally high for a much longer duration.
It's essentially using regulatory policy to choke out the competition's high-speed rail development. Now, the second rumor in the notes is about a potential strategic partnership with a company called Sima.ii. The notes describe this as Edge AI Co-optimization, which is, well, a lot of dense jargon.
It is a mouthful.
What does this partnership actually mean in the real world?
It is aimed at opening a massive new total addressable market in physical AI robotics. Up until now, the AI boom has mostly been confined to data centers, chatbots on a screen generating text or images.
Right, mostly digital outputs.
The next frontier is transitioning AI into physical machines operating in the real world. We are talking about autonomous factory robots, delivery drones, and self-driving systems that process visual data in real time.
And a robot walking across a factory floor can't wait 2 seconds for data to travel to a cloud server and back. It needs the brain right there in the hardware.
Exactly. That requires an entirely new architecture of specialized ultra-low latency memory that sits directly on the edge device itself. If they successfully pioneer that specialized hardware in partnership with Sema.ai, they aren't just riding the current generative AI wave.
They are building the next wave.
Yes, they are laying the foundational tracks for the next iteration of the physical economy.
So, synthesizing all of this data for you, the physics of the die penalty, the fortress balance sheet, the institutional accumulation, and the Jevons paradox, what is the final thesis here?
The quantitative summary of our analysis gives us a 9 out of 10 bullish score. The absolute core takeaway is that the market is wrong to view this company as a cyclical commodity play. It has transitioned into the foundational rail of the global AI infrastructure build-out.
It's a completely different company now.
It really is. With their high bandwidth capacity completely sold out through 2026 and those elite 81% margins, they are operating in a different reality than they were even 3 years ago.
And the valuation just hasn't caught up.
Right. It trades at 7 to 8 times forward earnings purely because the algorithmic trading models are irrationally anchored to the past. From an investment standpoint, this isn't a short-term swing trade. It is a multi-year hold, specifically an 18 to 24-month horizon to capture the bulk of this super cycle all the way through 2028.
It really requires a total recalibration of how you view raw compute materials in your portfolio. Which brings me back to that high-speed rail and highway analogy we started with, and the inescapable reality of the die penalty.
Yeah, that is the crux of it.
If advanced AI memory requires 3 times the physical silicon space, and that permanently chokes off the supply of the standard memory, and if the Jevons paradox guarantees that our global appetite for compute will only compound exponentially as AI gets cheaper, it leaves you with a pretty staggering question to think about.
What's that?
Are we entering an era where basic computational memory ceases to be a cheap, generic, abundant crop? Are we about to see raw memory hardware become as hoarded, fiercely contested, and geopolitically critical as oil or rare earth metals?